Hi folks, welcome to this new video, right? I promise to make this video in order to clear certain confusions and set this ship sailing, right, for some of you, right? So I'll just be going straight to the point, right? And this video we're talking about smart money key levels, right? That's basically what I promised of talking about, right? This is the Easter period, right? So I just wanted to, I plan to make series of videos, right, during this Easter period because I'm kind of um, at home and kind of less busy, right? But then I thought about it, just make just one, and the one will be just on this, right? So both paid mentorship students, this is all I've given you guys, all right? I've given you guys just this, all right? So I don't want to be having too many calls, right? So I can have time to rest and do some other thing, right? So talking about smart money key levels, right? So this is the introductory part, right? So I'll kind of be talking about them one by one and kind of explain them a bit, right? Although I may not go completely in depth because each of them have their own, it has a lot of nitty gritty, but just kind of run through all of them, right? And the reason why I'm running through them is because in case maybe you're on, or you don't know, you're new to this concept, you can have an idea, or you're in some kind of mentorship and since I'm not really checking in for you and you want some kind of refurbished knowledge, right? So to help you to set your ship sailing. And if you're in the paid mentorship group, this also help you, right, to get better and to improve your trading results, right? The goal of this is for you to understand why the market does what it does, right? You know, Beyond making money in the financial markets, what makes you a master is understanding the why, because that is what makes you the most money. When you understand the why, then everything begins to make sense. Even if you take a loss, then you'll be able to understand, okay, this is why I made a loss and all of that, right? So that is basically why this video will be released to the general public, right? So you guys can be able to answer the questions why, and right to also help you improve in your trading, right? Also for those that are in the free Telegram channel, all right, just keep plugging, the hold your seatbelt, and I advise you to get a writing pad, right? That the writing pad to write these things down, right? So we're going straight to um, smart money key level, right? So I'll be explaining what these are. So smart money key levels are levels where price reacts, right? They are levels where price will likely react. So that's basically what smart money key levels are. They're just levels in which you usually find price reacting of, right? So that's basically what smart money key levels are. The levels in which price will react. So get a pen, pause this video now, get a pen and a jot or something that you can write so you can get this point, right? So there are levels in which price will usually react, right? That's what they call key levels, right? Their price, when I look at this chart very carefully, you can see that there's certain area that this price, look at this, you can see that when price comes to this level, right, you can notice that there's a kind of reaction there. Can you notice that if I draw this in time, you can see that as price goes to that particular level, you can see how price find it difficult to break and price retested it and then it fell off the face of the earth. Right. So these are what we call key levels. Right? There are places in which price will usually find difficulty breaking through fully. Right. Look at that key level right here. You can see this key level right here. You can see how price finds it difficult to break it. You can see how it finds it difficult to break it. And if you stand at some time, you can see as soon as price broke it, you can see this retest on it. You can see how this level has acting as a kind of resistance or support to price. And that's what we call the key level, right? So I'm teaching you guys how to look at um, key levels from the smart money perspective, right? So I want to clear the air. I want to just clear the air. Now, when I say smart money key levels, I'm not talking about support and resistance levels like retail traders are talking about. That's why I term this video smart money. So I term this video smart money key level, right? It's not support and resistance and all of those bullshit that so many retail traders use, right? So let's go to the meat of the matter, right? So now we have several kinds of smart money key levels, right? Before I go into that, we have a paid mentorship group where we break down all these concepts right from the brass tacks, from the beginning to the very brass tacks, right? And it's actually going for a month, for a yearly payment, right? Of just about $58, right? Just for a year, right? So if you want to be part of our paid mentorship group, is very available. Just do what I join with the link in the description, right? It's very helpful. We just had a 50K funded trader using the concepts we taught him. We had another one that just passed, I think today. That is the day, right? I'm making this video, and so much more. Right? You can always check our Telegram community to see our result and see our track record, right? So let's go straight to the meat of the matter. And now we have, there are many of them. I'm talking about these ones which I want to release to the general YouTube community, right? So these are the smart money areas of key levels, right? I'm talking about them one by one, and this is it, right? So now we have old swing lows and highs and lows. I have psychological levels. We're talking about support and the resistance, right? I'll talk about this with respect to smart money, right? Not the garbage that's being sold online, right? So we talk about OHLC of old swingers and lows, and then the imbalance, we talk about big figures and then order block, right? So we're starting with the very first one, which is what the old swing highs and lows, right? This is what we're talking about first. So I'll just run through this. Now, because I'm not going to explain how to use them, because it's not just knowing them, you have to know how to apply them, right? I may not be going to read charts, but I will just be, okay, I might not go to read charts to show you what's one of two things, although I may not kind of dwell too much on one thing, right? Because each of these topics are very deep, and I've talked about them mostly the paid mentorship group. So, if you want to really learn, go in depth, right? Because YouTube cannot really cover, right? So you're just scratching the surface. You cannot really go deep into the needs of each of them because all swingers and needs can take about 3 or 4 different videos to actually break it down to from the beginning to the end, right? That's why we have the paid mentorship group where we have live calls every week, every Sundays, live webinars where we break these things down step by step, right? So let's go to the first thing, which is what the old swing highs and lows. So now, for the old swing highs and lows, they're looking at now the first thing you must consider when using old swing highs and lows are what we call the it's what we call when you talk about old swing highs and lows, we're talking about this now. Old swing highs and lows. So if you're talking about old swing highs and lows, the first thing you want to consider what the trend of the market, right? So you want to be considering what the trend of the market. So that's what the first thing you must consider when it comes to old swing highs and lows, the trend of the market, right? So what do I mean? When you're looking at old swing highs and lows, you want to know if the market is bullish or bearish. So the market is maybe trending bullish. You want to see the market making a series of higher highs and then higher lows. What do I mean? This is your higher low, this is your higher high. I think I should use this because I think it's very clear if I'm using this cross. So you want to this is your swing low, that's a swing high, this is a swing low, and that's a swing high. All right. So that is basically what I'm talking about. Your swing high, your higher high, higher low, higher high, and then your higher low, right? So you want to be looking at the old swing high. So the market is bullish. The old swing high is where you're looking at, right? You're not looking at the old swing low because that is basically support and resistance. So this becomes your area of what? This is because of the key level because most times this could be a breaker block, right? This could stand as a breaker block, right? And that is also an old swing high. So an old swing high in a bullish market is a smart money area of what? Support or a smart money key level. So most times you see price come to bounce off this and then make a new high. All right. So this area is actually one of the areas that you should actually look at when you're bullish, right? So you must understand the trend of the market before using old swing highs and lows. Now, the market is bearish, all right? You're looking at where the old swing low, right? In bearish, you must see the market trending downwards first. Not that the market is bearish now. I now go and draw and say, okay, you got me drawing the old swing low, saying, okay, let me buy it. This is garbage, right? This is what we call double top, and for me, that is garbage, right? It is actually a retail patterns that is going to that you're begging to fail, right? If you use all those patterns against the trend, right? There are times in which a double bottom forms, which is in line with the trend. For instance, like if you see the market, maybe the market is bullish, right? And then there's also like you see market coming to give a double bottom. Right? This is actually more high probability because why? The market is what? Bullish. I don't understand what I'm saying. So you can see the bottom in this kind of scenario. But when the market is counter trend and you're going for a double bottom, that is where you're begging to fail, right? And the market is going to be glad enough to hand you over your rare ends, right? It's going to hand over your rare ends over to you. All right. So this is not what you're doing, right? You're looking at as that old loop as an area for what short. No, you're not trying to buy it, You're not trying to buy support. You're looking at this to break, and this because of an old swing low, and then looking to do what, to sell when price comes into that point. And I love to see this when it's at the discount level. I love to see it when it's at 50%. That's what I love. I love to see this. What do I mean? If I bring out my Fibonacci 2, I love to see this old lows form at 50%. So I like to see it form at 50%. That's how I like to see it, because it gives me a more high probability trade. Because I like to see this looking this way, where if I measure from here to here, because smart money likes to take in trades from 50% and beyond. So I love to see trades that are actually at 50%, right? It may not be on this particular time frame, but on the higher time frame, I want to see this old low format at least 50%. And that makes a very high probability for me, right? So I think I've talked about this. So I think I should just show you guys this quickly in old in real charts, right? So let us quickly look at this now. Let's quickly look at this. Let's see if we can find something quickly. All right, so you guys can understand what I'm talking about, right? So look at this. Market was bullish. Right, you can see market was bullish right from here. You can see highs and lows. And then if you bring your two out, you can see that this old high, can you see how price broke through? What happened? It reacted, it broke through the old high, reacted off it, and then made a new high. And this is a daily time frame, right? So that's what we call a smart money killer. You must always consider the trend when you're doing this, right? Always consider the trend to be to do this thing correctly, right? So you can see this one too. Can see how this market changed from being bullish and then it became the market became was bearish. So you can see how this old low, I can see this old swing low, I can see this old low, how price kind of weak through to it a bit, but still fell off the roof, right? So that's how they play these things, right? That's how they play. You can see this one as well. You can see this old low forming here. Look at this old low. Market was kind of bearish because it broke structure here. So you can see how the market came to retest it. So you can see how the market was, it took out this swing low, that is a break of structure. And then you can see the market came to retest the old low and then rally high. All right, so let me also point out something. When you're using swing lows and swing highs, look at the highest point that price made, right? Always look at, mark the highest point, right? So just to be safe, what do I mean? If you see maybe a candle, you're looking at the highest point. That's why you should be looking at the highest point that price made. Right? Sometimes you can dig deep a bit if it's a candle or something, right? What do I mean? The market is bullish and then you see market break an old high. Always mark, if you're using a line, well, I usually recommend to use a box because sometimes it may not be a particular level, right? So you can simply mark that, that is that highest point of the market, and then that is your key level, right? So you can look out for buy opportunities in that region, right? So now, next thing is the psychological levels, which is support and resistance. But I'm talking about this from the smart money approach, right? So from the smart money approach. Now, psychological levels are levels in which price gave a sharp rejection at previous times. So there are levels in which you see price giving a sharp rejection from the higher time frame, right? So you can see a key level right here. Why? Because you can see as price came to this level, you can see this sharp buy, and this buy bought for a small number of days. You can see how price came there again. You can see how it never came back. So that's what we also call a key level, right? And if you extend that in time, you can see how price broke, retest, and then it fell off quickly. So those levels in which you see price giving a quick rejection, a quick movement, that's what we call psychological levels, right? They're actually levels of, they're also smart money key levels, because if you also extend this, you can see how price found difficult to do was to break through. Like I said, the market was finding difficult to break through at the level. So those levels are levels in which you can always expect that price would react if it comes. And if you extend this in the future, you can see how what happened. Can you see how price still came here and it bought for 1, 2, 3 days? You can see the first. So these are what we call key levels, and they must always combine this with the trend. So the market, if you're bullish, and maybe that's not maybe you're bullish, and maybe price happens to break to this key level, right? You can actually look for what a retest at this key level, right, to buy, right? So this case, why I did not, because the market was bearish, that's why I did not hold. So like I told you, although this is a daily time frame, right? Imagine you caught this by this. Let's see how many pips that was. That was about it's moved about 309, about 400 pips. So even from here to here, it moved about 400 pips, about 400 pips. So you can see that even though you call this by, you have made about 400 pips, I like to use this in line with the trend. I want to see market being bullish and then breaking a psychological level, coming to retest it and then That's what I'm looking at for. So psychological level are levels in which price gives sharp rejection, of price finds it difficult to break through, and then it gives a sharp rejection. Right? You want to see that sharp movement, you want to see price hovering away from there. Right? So that's what we call key levels. Right? And then yeah, the next one is the OHLC of swing highs and lows, right? So talking about the open, the high, the low, and close of swing highs and lows. So I'll kind of be giving a simple analogy to explain this better for you guys, right? So when I mean OHLC, I'm referring to open, high, low, and close. If you look at my charts, I don't have it anymore. You usually find, I don't know why it's not here. It's usually on my, let me see if I can see it quickly on my settings. Okay, high, low, price. No, I think I will look for the settings. Usually, I don't know, it's used to be usually here, open, high, low, and close. So, wow. Let me see quickly. Let me see if I can find, look for, can see. You can see it's activated actually, OHLC. So I don't know, let me just quickly look for it where it is. Okay, because the candle is not on, that's why. All right, sweet. So you can see open, high, low, and close. So I'll be explaining what that means and what it has to play with this. So now, when I mean a swing high, I'm looking at a candle that has a lower high, and okay, for a swing high, I'm referring to a candle that looks like this. It has a lower high to both sides of it, right? So when you say market, a candle that has a wick, then a lower high to the left and a lower high to the right. That's the price. You want to see this. This is what we call a swing high, right? I will not go too deep into this because it might actually confuse you guys, right? But this is what it looks like, right? You want to see a candle that is looking like this. That's a swing high. And then a swing low. You want to see market, you want to see a low that's lower than two previous lows. That's what we call a swing low, right? So I will explain that. So let's go to chart and kind of explain it. Now look at this market carefully. Now, why is this point a swing high? Look at this. Or let's start with a swing low. Right? Let's start with a swing low. Now look at this chart very carefully. All right. Look at this. What can you see? You can see that this low is formed. Can you see a low to the left? Yes. A low to the right? Yes. So this is what we call a swing low. So a swing low should have a candle to the left and a candle to the right. And for credit reasons, I learned this from ICT, right? So I'm giving credit here. I learned this from ICT. It's not my invention. This particular one is not my invention. I learned it from the inner circle trader, Michael Huddleston, right? So that is it. So when you look at candles that if market is bullish, it's a swing low, it has a lower high to the left and a lower high to the right. I mean, lower low to the left and a lower low to the right. So this is what we call a swing low, right? And that's your area of interest, right? You're looking at the open. Let us just mark it out, right? So you're marking what the open of it. You're marking what the low. So that was the close. Sorry, you're marking what open, and then if it has a high, then you can mark the high. So these are the areas you're marking because they are what psychological levels in which will hold price in the future, right? And look at what happened. Can you see what happened? This is actually the close price. What happened there? Price just came just about there. So this is actually the high of the candle. So around there, this is the high of the candle, right? Remember, open, high, low, and close. So can you see the markets came just at the high of the candle? What happened? An explosive move to the upside, right? So you're looking at those kind of candles because they are candles of what interest. Now look at this one. Look at we have a swing high here. You can see a candle to the left and a candle to the right. So you're looking at that particular candle for interest. So you have to also mark the levels, marking the high, the close price, and marking what the high. Right? I want you guys to understand this. You're marking what the low. Right, so let's take it a first. Can you see? Markets came where? That's the high, trace off, and then can see how price finds it difficult to go below that skill level. And then look at this. Market was bullish. What did they come to? Where? Can you see? Just that the high of that swing high. Notice that you must see a lower high to the left, to the right and to the left. How makes the swing high? I must be doing this in line with the trend. So if we go to the lower time frame and maybe you attempt to buy, right? You're looking to buy at that key level, And if the market turns bearish, you're looking to sell when the market, let's assume that this market was bearish, right? So you want to be selling maybe when the market breaks through and then it comes to retest that key level, right? I won't go into more there because this is actually, I'll be teaching the paid students deeply on this, right? Or let us go to the 4 hour so you guys can understand. Since I've started talking about, let us go to the 4 hour. Right. So look at those levels I marked. Can you notice that? See how price are bouncing off this level. Look at the levels I marked. Can you see? Look at the levels I marked from those swing high and swing. Can you see how? Can you see how the market is bouncing off that key level? Can you see? Can you see how price is? Can you see how price stalled there? This is the lower time frame now. Can you see? So go smart money was key levels. Can you see this? Can you see how the body of the candle feels to? Sometimes markets can weak. Always pay attention to the bodies of candles. Now the market is in what? Is working below, but look at how it is respecting this key level, right? That is giving you a sign that you want to do, you want to rally higher. And this market was bullish, have a higher high, higher low, higher high, then a rally up. Can you see how? Look at how the market is failing to close below. It failed to close below here. Can you see how this key level is respecting? So the levels you're looking at, and as the market came to this upper half, can you see how it dropped a bit, bounced off another key level? So the market goes from key levels to key levels. So understanding the smart money approach to key levels makes you what ahead of other traders. All right. So I'll just be running through the last three. All right. Imbalances. These are imbalances are candles that create gaps. Right. So these are imbalance. And imbalance simply means you're looking at when you see a candle that does not have any candle between, you just see a big candle. So you mark the low of a candle and then the high of the candle. So a key level because it will see reaction. Look at how you see how price bounced off. So you always do this in line with the trend. You want to see imbalances form and we call this sell side imbalance. This is what we call the CB. So you want to see the market bearish and then create an imbalance, and then you're looking for price to come into that key level, which is what the imbalance. So you want to see markets come into imbalance and then do what trade lower. So you're only looking for imbalances when the market is what bearish. That's what always gives what confidence to what enter your trade. So when markets comes in, can I look out for a lower time frame entry? And I'm not teaching lower time frame entries here, right? So that is it. So I won't be going too much deep, but this is actually paid mentorship stuffs, right? So I won't be going too deep into all this. I'm just giving you guys an overview of all this is, so you can actually back test or join the pay group where we're talking about these things in deep details, right? And it's very affordable, just $58 for a whole year. Is $58 not? Is it too much to invest in your career and learn how to read price once and for all? We have students that have $50,000 in our academy. So if you are not with us, then you really give yourself some harm, right? So let's go to the next thing. Now, the next thing I'm talking about is what? Big figures. So big figures are numbers that have 20, 80s, and 50 levels, right? So looking at numbers that are big figures, right? Numbers like numbers that have 20s, these are what we call big figures, right? We have the 20s. I also learned this from ICT as well. 20s, 50, 80s, and 00 level, right? So these are big numbers. Numbers like 1.8800, right? Numbers like 1,000, 1.000. Those are what we call big figures. And these are areas that mass market likes to reject off, right? Now, looking at this swing guy, I can see that there was actually a big figure here. Look at it here. So look at where this market rejected. What do we have here? Can you see that it was around what? The 1.9200 level. So what we're talking about, so those are numbers that the market loves to play on. We also call that, I what we call smart money was key levels, right? So can you see that price came exact to 9200 and then it dropped? Can you see how the market failed to break? Look at this. Let's extend this in time. Market took out the previous high. Look at this. You just go to that 9200 level. What happened? You can see this sharp drop, right? So most times, Saturn is looking at these big numbers because when they are doing their orders, they like to use big figures, round numbers, like numbers like 19000, 1950, 1980, 1920. These are the levels that smart money like to use for their trading. So you're using that, they're looking at big figures and quarter numbers for your setup. So if you're bullish and maybe price, all right, I have a way which I actually use this on the lower time frame for my entries, which I only teach the paid students. I won't be discussing this here, but also showing you guys exactly what I'm doing. Look at this level now. What do we have here? We have a 50 level, right? So if I bring out my number, I can tell that this sharp rejection happened off a key level, off a big figure. So look at this. It was actually at what? Let me take off all this so you guys can see clearly. All right, so this number, so I'm paying attention to this particular number here. Can you see? It's just around 7,200 levels. So if I just edit it, it must not be very clean. I want to see price failing to break those levels, right? So you can say it's very, very close to what's 9,200, right? So it also applies to 50, 80, and 00. It could be 91070. So must have other reasons. Can you see? 9,200 level, 7,200, and you can say price finds it difficult to break what? That's what that big figure. All right, so you must always have that in the back of mind. And then we have what we call order blocks. Order blocks is already taught in this paid group. I mean, this free channel, last up candle before what? A breakdown. That's the order block. So that last up candle before it push, the heavy push the down. Also called an order block, right? So we always expect price to store when it comes there. All right. So I think I should just give an example of another block where price played off an order block and it ran away. Right. So we had an order block here. So this order block, you can see this order block here. You can see that as the market came here, gave some kind of accumulation of longs and then rallied higher. So you can see how price came back, and if you extend that in time as well, some people call it supply and demand zone, right? You can see how price is finding it difficult to break that order block, right? So order blocks are also levels of smart money key levels, right? So let's look at more examples. We have this order block right here. You can see this other block right here. Last up candle before that heavy push. You can see the market um, failed to break above, just kind of weak through. Note that price can weak through key levels. You can always see a weak, a manipulation above it, but you want to see price fail to close above. You want to see price still rally away from it, right? So you had the other block there, very clean one, and the market sold towards this key level. So you can use key levels to anticipate where price will likely turn, right? And it's helping you in your trade. So if you're bullish, always make sure your notes when you're trading lower time frame, always have a key level around your entry. So if you're bullish, let it be at a bullish key level. If you're bearish, let it be at a key level, and it could be any of these levels. So I won't be talking about lower time frame entries, right? I'm just giving guys an overview. So if you want to really go in depth with this concept and understand how to use them on the lower time frame, all right, just do it to join the paid mentorship group. Send me a DM or use the link in the description, right? Or use our seller link. I have a seller link to be posted in this group, so you can just enroll and join us, right? So I hope this video was insightful. If you really learned something, do it to drop something in the comment section and like this video, share with your friends, and I will see you guys in the next video, right?